Ever heard of SIF? It's the latest buzz in India's investment world. A new category introduced by SEBI in 2025 that aims to bridge the gap between traditional mutual funds and higher end products like PMS or AIFs. But what exactly is an SIF? How does it work? And should you consider investing in one? In this video, we break it up all step by step. SIF stands for Specialized Investment Fund. It's a newly created investment framework under SEBI's regulations effective from April 1st of 2025 that gives fund managers more strategic flexibility than a typical mutual fund, yet with more investor protection than many unregulated alternatives. In essence, SIFs allow investment in more complex strategies, leveraging derivatives, shorting, thematic bets, specialized sectors, but under a regulated, transparent regime. So why did SEBI feel the need for this new category? Well, for years there's been a middle ground missing. Mutual funds are highly regulated and accessible to millions, but often constrained in strategy. For example, restrictions on derivatives, leverage, concentration bets, etc. On the other hand, PMS and AIFs offer more freedom but come with very high minimums, less liquidity, and are suitable only for large investors or ultra HNIs or institutions. So SIFs aims to fill that gap, provide more flexibility and access to advanced strategies, but with SEBI oversight and certain guardrails. Now let's look at the regulatory structure and rules that make SIFs distinct. So who can launch SIFs? Only asset management companies with sufficient track record. For instance, AMCs that have operated for at least 3 years and have an average assets under management of 10,000 crores over the past 3 years. The newer AMCs can also launch the SIFs if they have a CIO or a fund manager with proven experience. From a branding angle, SIFs must have their own branding distinct from the mutual fund's mainstream schemes in order to avoid confusion for the investors. Is there a minimum investment required to invest in SIFs? Yes, a fairly high entry threshold, typically 10 lakhs per investor per PAN level across SIF strategies. What about the portfolio restrictions and exposure caps? Maximum short exposure via unhedged derivative positions is capped, usually 25% of the net assets. Limits on single issuer exposure in debt instruments. For example, a single issuer's AAA debt exposure cannot go beyond 20% of the NAV. And there will be sector limits also. Let's talk about subscription, redemptions, and liquidity. Okay, some SIFs may be open-ended, closed-ended, or interval funds. That is, you can invest, redeem only at scheduled intervals. In case of non-daily redemptions, units must be listed on a recognized stock exchange. So SIFs will use a 5-level risk band system to communicate risks to the investors. AMCs must monitor daily investor thresholds. Passive breach due to NAV erosion is allowed, but investor may have to redeem if it goes below minimum threshold. So derivatives and shorting is allowed within caps, giving managers more flexibility for strategies. So now the fun part. What kind of strategies can SIFs deploy? The new regulations allow several sophisticated strategies under careful limits. Here are the main types. Equity-oriented strategies, long-short. So equity long-short fund, the fund holds long positions in equities expected to go up and short equities expected to decline. The minimum investment in equity instruments is high, example 80% of assets. Short exposure via derivatives is capped, example 25%. The next strategy is equity X top 100 long short. Focus here is on stocks which are not amongst the top 100 by market cap. So they are typically mid and small cap stocks and using long short strategies them. The third strategy is sector rotation long short. The focus is on at most 4 sectors, going long in sectors expected to outperform and short in sectors expected to underperform. Like for example, today the technology sector is underperforming, whereas sectors like gold or infra is outperforming. So the fund manager can take bets as per this momentum. Debt-oriented strategies. Now, debt long-short funds take long and short positions in debt instruments or via interest rate credit derivatives. The other strategy is sectoral debt long-short. Focus on debt across sectors with limits per sector and shorting permitted via derivatives. The next strategy is hybrid multi-asset strategies. Hybrid long-short funds, they mix equity and debt, maintaining minimums, for example, at least 25% in each, while allowing short exposure. The next one is active asset allocator strategy, long-short. A more dynamic strategy where the fund can move allocations across equities, debt, REITs, InvITs, commodities, utilizing short positions as needed. These are typically interval funds, that is non-daily subscription or redemption. There's one important rule across all the strategies. Even if a manager uses derivatives or short positions, they can't exceed the caps set. Example, short exposure up to 25% and net exposure rules apply. Because many individual investors lose money trading options and futures. SIFs place this complexity in the hands of professional fund managers. A SEBI study has shown that 93% of individuals traders in the F&O segment suffered losses over financial year 22 to 24. Now let's talk about some pros and more importantly risks involved with investing in SIFs. So what are the advantages and potential benefits? So you get access to advanced strategies. You can benefit from the long, short, hedging, sector rotation, etc., which are not feasible in typical mutual funds. Better risk-adjusted returns. Especially in volatile or sideways market, a long-short strategy may outperform plain vanilla directional funds if the manager is skilled. So SIFs fall under SEBI regulated oversight, which mitigates unregulated risks. See, for investors who can't go into PMS or AIF due to minimums but want more than the mutual funds, SIFs fit the bill. So what are some of the risks or challenges while investing in SIFs? Higher complexity. See, strategies involving derivatives, shorting, leverage are more complex and not all fund managers might excel at it. Liquidity constraints. See, some SIFs may have lock-ins, interval redemption windows or listing requirements for exit. Higher minimums. So 10 lakhs or more may be steep for many retail investors. Risk of losses in adverse markets. See, derivatives and short positions amplify risk in volatile conditions. Manager risk. Skill and the risk management of the fund manager will matter more than anything else in typical mutual funds. Passive threshold breach risk. If the NAV falls such that your investment goes below minimum cutoff, you may be forced to redeem your entire investment, unlike partial withdrawal which is allowed in mutual funds. Okay, the bottom line is simple. SIFs is a great instrument, but is it for everyone? No, it is not for everyone. They are more suitable for those who understand risks and the dynamics of complex investment strategies. When we compare mutual funds, SIFs and PMS AIF, the differences become very clear. Mutual funds are built for mass retail investors with very low entry basis points. They are liquid and through daily redemptions, you can pretty much redeem any mutual fund at any point in time. And they also undergo strict oversight. SIFs, on the other hand, demand higher minimum investments, 10 lakh plus. They offer moderate to higher strategic flexibility, including derivatives and shorting within caps. And they have variable liquidity depending on their structure. They are also SEBI regulated under a new framework and best suited for, again, as I said, sophisticated investors with higher risk tolerance. Now, PMS and AIF sit at the top end, often require 50 lakhs to 1 crore plus with a wide strategy freedom but lower liquidity and heavier dependence on the fund manager's skill. Mutual funds are for the masses, SIFs for the affluent risk aware, and PMS and AIFs for the ultra HNI clients who are seeking bespoke strategies. So SIFs sit between mass mutual fund world and the high-end universe of the PMS and AIF, offering a middle path. SIFs are suitable for investors who are comfortable with higher risk and complexity, have the required capital, 10 lakhs or more, seek more strategy options than ordinary mutual funds, have a time horizon, that is, they don't need immediate liquidity, are able to do due diligence on fund managers and strategies. So if you are a first-time investor, it might be wise to first gain experience with simpler instruments before venturing into SIFs. To make it more concrete, here are some few early SIFs which have come in India. Quant Mutual Fund has launched the QSIF Equity Long Short Fund, India's first SIF with open-ended structure combining equity exposure and capped shorting via derivatives. Specialised Mutual Fund under its Alteva platform has launched India's first hybrid long short SIF. SBI Mutual Fund has launched Magnum Hybrid Long Short Fund as its first SIF offering. Tata Mutual Fund and Bandhan Mutual Funds and others are lining up documents with SEBI for launching their own SIFs in the long short world. These early funds typically offer interval, hybrid structures, blend equity and debt exposure and allow derivative use within limits. They serve as pilots for the SIF concept in India. So if you are considering investing in the SIFs, here's a quick checklist. Read the scheme document carefully, focus on strategy, derivative usage, short caps and redemption terms. Check the fund manager's track record, especially in derivatives, hedging or long short strategies. Understand the risk disclosures and stress scenarios as provided in the documents. Look at liquidity, redemption terms, interval windows, lock-ins or exit costs. Check the minimum investment and whether your capital suffices. Understand the costs, fees, especially for the derivative positions or special infrastructure costs. Monitor portfolio exposures, constraints, whether the fund stays within caps and compliance, and always consider only allocating a portion of your portfolio initially, say a small exploration allocation, until you understand how the SIF behaves in different markets. So what are some of the summary and key takeaways? SIFs are a very new regulated investment category in India as of April 2025, designed to give you more strategic flexibility than mutual funds. They allow advanced strategies like long, short, equity, debt, sectoral bets, derivatives, but with regulatory caps and guardrails. They aim to fill a gap between mutual funds and the high-end PMS AIF world. While they open new opportunities, they also carry higher complexity and risk. Suitability matters. So if you decide to explore SIFs, do strong due diligence. Start small and treat them as a specialized allocation in your broader portfolio. If you'd like a deeper dive into how long short works or want to see side-by-side comparisons of real SIF performance once data is available, please do connect with Team Enrichwise. Thanks for watching. If you learned something new, hit the like, share and subscribe button, and also comment below with your questions on which fund strategies you'd like me to analyze next. And yes, this is not a financial advice. Please always consult a qualified, experienced professional before investing. See you in the next video.